Okay, here's what I hope to do with this video. I hope to show you about how to use the PE ratio to back into the cost of capital when you have changing parameters. It's a corporate valuation issue, but I also hope to show you, oops, I have a coat on, excuse me for the crinkles in the sound of the video. I hope they don't irritate you. I hope to show you how to use the interpolate function that kind of I've been working on, and I think it's getting there. And really, the distortions, at the end, I want to show you the distortions that happen when you've been trying to measure the cost of capital from one of these formulas. I hope you understand that this dividend growth formula is kind of bull crap. Sorry, that wasn't a swear word. I mean, this one, to think that dividends are going to grow when you don't put on any of the kind of value drivers in here is not very good. So putting these value drivers is an innovation, but it doesn't work as well as it's promised, really. Now, so we're on this page called varying parameters. And of course, but this file, just in case you want to see where it will be, is going to be in the advanced valuation with corporate models in that section. But I've got to clean up a little bit, but it'll be in that section and on this Google Drive, it would be in chapter number 1, and then you look at the cost of capital, and then you look at this cost of capital analysis. And this is the price to earnings analysis. Okay, try to put some of these things together. Sure, eventually you'll have some other comments about it, but here's what happens. We put some parameters in. Now, for the first case, I've just assumed the ROE for the current and the long term is the same, and the long-term growth and the short-term growth are the same. Then we are going to talk about just a little bit about some of these interpolation issues. We're going to work through, I don't know if I have to really work through this, but this is the same kind of thing that was talked about in the prior visit, that I talked about it. Well, I don't use the passive tense. In the prior video, but this time the ROE changes and the payout changes. So the ROE is we worked out this formula that you take the ROE and subtract off the amount of the ROE, the component of the ROE that's related to the assets just growing because of inflation, which is non-cash. The dividends are still the dividend payout ratio, or you could take the growth minus the ROE minus the growth, either one. And that's the amount of cash you actually get. So then you and I added something else here. I said, well, from our last video, we know that the market to book which is the ROE minus G divided by K minus G. That formula can be used in the terminal value as long as we have a constant ROE and G. So what we can do is just take this last terminal value and multiply it by the ROE, and then we get our total cash flow, and we don't have to do a 50-year model. We can just do it as long as it takes until we get a stable period. You can work through the formulas. I don't think there's anything that dramatic in what I said. And then we take the NPV at 8%, see what the earnings are. The earnings are the total ROE, but you take out the inflation component of that because it's not really expressed in earnings. You have to deflate that, and then you get this ROE, this PE ratio that's the same as the real PE ratio. Okay, and then that's our 20.5 PE ratio, and we used our K. If we wanted to back into it, we just used this same formula. You notice I used arranged names, and we use the same formula that was derived over here. So if it's all constant, everything's fine. But now we're going to change things and make them not constant. Now to change things and make them not constant, I apologize for struggling a little bit with this, but I think we together, you're on my team. I hope we have something good. I mean, to come up with a good way to interpolate that doesn't crash the Excel and all that, it turned out for me to be a tiny bit more difficult because I kept on going through iterations, and I think we have one now. So in this function library that I'm going to not interpolate, but that I'm going to put on the website, there's a function called interpolate and look up and interpolate, and it says step 1, go to the developer tab. Okay, let's go there. Step 2, go to the macro and take, let's put it this workbook, take the functions. Okay, and then I can't read it anymore, but it must say step 3, go to edit the functions. Make sure at the very, very top you've got this one. So here's what this is a mess. This one should be all the way at the bottom. And then you just select the whole thing and copy that and put that into your initial file. This step 4 you don't have to do anymore. I fixed that. That was hard to fix. Now sometimes, occasionally, you have to press this recalc button. It takes a minute because if you put a function in Excel, you sometimes have to recalculate. It's like you press the F2, you have to recalculate just that specific thing. So you sometimes have to press kind of F2. Instead of doing that, you can make a little recalculate macro that works through all this works through the columns and just recalculates a single cell. I have no darn clue as to why that happens, but sometimes you have to do that. Okay, I'll address that in other videos as well. Okay, but the good news is you put that in, and then now we have our, I use the look up interpolate linear because sometimes it doesn't work properly. So let's say it takes 10 years to get to our stable rate. So we put a stable, let's make okay, let's make this 12%, and let's say it takes us, and we get down to 9%. Well, let's say 10%. So we're still above the cost of capital. How about, yeah, let's leave that at 8. Let's make this 13, and let's leave it. That's okay. How about 9.5%, as if it really matters. And then we've got to be above the rate of inflation. Let's say we're 5%, and in 5 years, by the end of 5 years, we go down to, let's say it's 6%, going down to 3%. Now, when you do that, here's the problem. We put in 8%. Now, we have growth rates changing, which changes our payout ratio. Our payout ratio is changing, hopefully, because both the, I don't have the year in here. That's too bad. But it's changing both because the ROE is changing, and then it stabilizes out here, and then you can put your terminal year. You better have your terminal year after your stable period. And now you get a PE ratio of 15. Okay? I'm not doing much macros or Excel or anything else. You know, here in this developer, if you go to macros, if you go to functions, it's got the same interpolate macro function. So I just copied that into the file. Okay, so that's that. Now here's the problem. The problem is when we use, with the real cost of capital we actually had in our model was 8%, but when we use this formula, either without inflation or with inflation, we don't get it. And we're going to have to use this model with changing parameters, and we'll make a goal seek. The goal seek is the first and last kind of macro I think you should make. Now, I named this cell difference, didn't I? Yeah, I did. And I named this one, hopefully, cost of capital. I'm not getting into the range name debate. Okay, we've talked enough about debates. And now we could do a goal seek, of course. Data, what if analysis, goal seek. I would normally suggest that you set up a little thing with a difference like this, and you just make that equal to 0, and to get there you just change the cost of capital, okay? It's clunking along. It's taking a little bit more than I wanted it to. Okay, I think part of that might be that I have this interpolate lookup function open because I have a zillion little examples in here. Okay, now instead of doing that, let's just change a couple of the parameters. Let's make this 14%. Okay, and now of course these are different again. And how about we make this 3% and we go up to 4%. So now, I don't know, we get, again, these, it was supposed to be I'll start with 8% again, okay? So what now, I'm pretending we have an observed PE. Now these formulas are working with the observed PE. I should have mentioned that more explicitly with you before. So this time, let's press Shift Control M to get rid of the little thing. Let's record a macro. We can just call it goal seek. I probably have one already, so I'll replace it because I'm about the third increment for this stupid video. And then we go to data and we go to what if analysis. And now when you make a goal seek, and we're recording a macro, same thing, just click on this. Click on 0. Make absolutely sure you don't start moving the cells around, okay? So our cost of capital now is actually 6.5%. Let's stop. Oh, no. I'll stop recording the macro. Okay, so 6.58%. These things got it wrong. Now, we'll attach the macro to our beautiful little button. Okay, and then when we attach it, now let's also modify it. You know, rule number 1 kind of about making macros. That's when you do need range names. So this was, I think, diff. This was cost of capital. If I get this right, I'm going to be so proud of myself. Shouldn't be. Because I used the, you know, Shift Control F3 to define that. Now that's what I do. Check it right while you're here, because if you're like me, you make all those mistakes. So of course now we can make this one 6% and go all the way down to 2% below the inflation rate. Then we get cost of capital of 5% versus these crazy numbers with our formulas that don't come anywhere close. I didn't realize the growth rate would make that much difference. Let's put 4% and 3% and try it again. Okay, so we've got our goal seek built. All right, and we've got our implied cost of capital, and we realize that these things with the formulas, when you don't change things, don't work. And I don't know if we could probably understand some biases if we put, let's say that we put 7% going up to 10%, which might be giving us a very funny result. Now we get 9.88, a higher number, so you can see the bias that comes from when you have to change the cost of capital around, and there's no kind of good little way to do this without going through some kind of interpolate function, I think. So I hope I know this is redundant a little bit to what we've been doing in other things, but I'm going to make a third video on it, and then I'm going to be finally finished with this cost of capital thing, because I have a backload of a lot of videos I want to do. Then what we're going to do is some scenarios where we change the growth period, what happens to the short-term growth rate, the long-term growth rate, the return period, and we're going to try to understand and incorporate some of the scenario analysis in here. We're going to have to incorporate the macro. There's going to be a few different things to do to really get this to kind of work. So I've just put some initial parameters, and we can even we can take the PE ratios kind of from our, well, I suppose we can take them from here. The S&P 500, that's an extremely high PE ratio, 24, but I suppose we'll leave that. Okay, that's the next video. Okay, enough of this one, only 15 minutes.